Welcome to Advice from the Deal Room. I'm Ben Record.
I'm Matt Russell.
Today we are talking about the debt maturity wall. What happens when your loans come due and now you have to refinance at 7% instead of your lovely 3% that you got back in 2021, 2022? So we're going to go into that. We're going to talk high level about what's going on, what caused this, what some property owners have maybe not been doing great, what things they've been doing good to prepare themselves for this, and what some takeaways you guys should do in the next couple months to prepare for this refinance if you guys have one coming. So Matt, what is the debt maturity wall?
That maturity wall is lots of loans, commercial loans in the sector that are coming due for refinancing here in 2026, 2027. So there is a tidal wave, is what they're calling it, of loans that are maturing or set to mature or reprice over the next year and a half, about a year and a half or so. These were loans that were made during much lower interest rate environment than we are at today.
Much lower. Just for a little bit of context, what kind of rates were we seeing for some of those back in that time, Matt? Those good old days.
Oh my God. Good old days. I'm just remembering that. So I'm trying to remember this is 2026. So if you're going back 5 years, which is good portion of loans are on a 5 year. A lot of people did 5 year rates in those times. Those rates were in the low threes. I did I did some loans fixed for 10 years at less than 3.25 during that time. So if you have any of those rates coming due, I mean, the rates are double today. But it's this crazy thing about like, man, times are good 5 years ago, 4 or 5 years ago. Yeah, we were doing very low interest rates in that environment because that was the interest rate environment. If you look at the treasury market at that time, treasury rates were low, spreads were a little bit lower than they are today too from all lenders. And so we had just very cheap debt. That was us coming out of COVID era, and that was still somewhat COVID era, but we're coming out. So that is why rates were so low. The government was just pumping out so much money, putting free money to keep the economy surviving, that we got all these cheap interest rates.
Yeah, we got very cheap interest rates. And I mean, we were having people that were leveraging at the max that you can do too. I mean, 80% financing on stuff because it cash flowed on those low rates.
And they cash flow significantly well at those low rates because prices hadn't quite caught. They were starting to move at that point quite a bit up, but they were still not to the point of, people could go 80% and still blow past the 125 debt service coverage ratio on a multifamily property, let's say. They could blow past that and be well above what they need to be. So getting the 80% was a no-brainer. And, at those lower rates, we locked in a lot of our clients in more 10-year money at that point. But there's not every lender you work with gives 10-year money. It's just funny how banking works too, Ben. You think about 10-year money, you're like, why would a bank give 10-year money in the lowest interest rate environment we've ever seen? And why would they do that when that's going to hurt our portfolio over years to come when rates do come back up? Because we all know it's going to come back up at some point. Why would you not lock people into 5-year money at that point, which a good portion did, and then let them reprice in today's environment, which, that's the problem now. So those lenders that did that are the ones that are going to have problems in their portfolios.
Well, and the ones that push to do that are going to be the ones that are going to look like they're pushing a bunch of people out of their bank when they come time to refinance because they're not going to want to work with them at these rates. I mean, property incomes have gone up some since then, but not anywhere in the ratio for what debt service has gone up that you're going to need to refinance them.
Yeah. NOI has come up on some, but rents increased in the last 5 years on properties. And this is not just multifamily. This is across, you know, asset sectors. However, there's been increasing expenses that's starting to erode away some of that increase in rents. And we're starting to see the perfect timing of a wall like this, the tidal wave coming is what's going on in the economy today. So you have that hitting at the same time when you have the market dynamics of a tidal wave coming from maturities, but then you have what's happening in the world and interest rates higher. That's one thing, but the economy not as strong as it was 4 3 years ago. Even then, in the middle of part of these loans, you have some higher vacancies in commercial properties than you did. You have rents coming down a little bit because there was a lot of supply putting on the marketplace for multifamily, where now the supply has outpaced demand for a little bit. So you're getting a little lull in what you can get for rents, or you're giving away free rents. So that hurts on your NOI calculations a little bit. All those things, when you have the income not matching step by step, all the way up to be able to go, okay, what happens if? Well, what happens if rates go there, in 5 years? Well, shit, they went there. Well, everything will keep up with it. Insurance doubled. Everything went up. There's property taxes that increased. But the biggest thing I would say is insurance been one big factor. And then cost of labor for any repairs and maintenance has gone up too. And now we're living in a world where things are a little bit tighter, much tighter for the everyday consumer. So that always has a downhill effect back to property owners.
Well, and you had during the whole COVID period, you had massive issues with supplies for fixing properties and building homes and construction supplies and all of that too. And so it all affected it. And like you were talking about, Matt, the prices for multifamily and commercial properties hadn't necessarily gone up quite as much during that initial phase, but on the other side, residential had already kind of reached its high. And so like right as residential kind of balanced out, that was when we saw commercial continue to kind of come up in the pricing more. But the price to borrow has only gone up along with that too, which is what makes it a very unique situation we're in.
And we were headed in a much better position. We were starting to head into a better position 3 4 weeks ago before the Iranian conflict.
Mm-hmm.
We're starting to head rates were dipping down. The 10-year was below 4. Everything was looking like, okay, anybody's going to reprice. They can reprice it, not as painful, right? And do they have to bring some capital to the table? Maybe, maybe not, to get their loan to cash flow appropriately according to the bank guidelines. How does that play? That could change. It's going to be interesting to see. We were expecting some more of that tidal wave happening sooner than, and it quite hasn't impacted yet. I do think some lenders are working with some clients, some of those borrowers, good borrowers, but we haven't seen quite the big tidal wave that we're expecting, that it will be headed down our
Yeah,
path
it's going to hit
soon.
no matter what. And we
And
kind of
so,
touched on our one with Jay a couple weeks ago, just that a lot of people have been kind of playing well, we'll just wait. We'll just wait for rates to come down. So, what are some options that lenders might be giving borrowers, or what might borrowers be trying to get from their lenders to handle this without necessarily a full refi right now?
one option that's going to be clearly on the table is continue to extend at the current rates and terms that they have. That's the easiest option. Is that the option that lenders want to pursue? Yes and no. The reason I say yes and no is yes, they want to make sure that they can continue to get repaid back, because the main goal of a lender is to get repaid back while you make some money doing so. The other thing is, if they know that the client has equity to sell today at today's prices, some might be forcing them to liquidate, and it's going to be circumstantial based on the borrower's own personal circumstances. The strong borrowers are in a different position, and these are loans that are made at your regional, national. These are not loans that we're talking about that are sold on the Wall Street. We're not talking about the CMBS, more Fannie Freddie agency stuff. You can read that in the news about the servicing issues they're having with some of this. They are providing some extensions out there, but sometimes they're making them take haircuts. The lenders are taking haircuts sometimes on these deals. They're taking back some properties. There's different avenues depending on the circumstance. When you're going out to the CMBS and agency world, those are non-recourse bad boy carve out loans. So In a sense, the client can just say, here you go. You're not willing to extend it, take my asset back. Is that the dream for everybody? No, because that causes, if the tidal wave does hit and causes problems, there's a direct negative impact to values across the market too. So when you're getting flooded with properties on the market that are now in foreclosure sale and things like in those situations, short sales, whatever it may be, that starts to draw down prices for everybody else as well. In theory. Now in practice, we'll see. Hopefully we don't have to see, but those
Yeah,
are
hopefully not.
that's how the math works behind the scenes, right? Is we if you have these many assets that are out in the market, open marketplace, that are distressed assets, it brings down the value of the non-distressed assets out there. And if you're a long-term holder, what's it matter to you? If you got the long game, it's like your stock portfolio. Stock market's down. Why do you care? You selling today? Don't stress about it. If you're not selling it today, you don't need the money today. It's not your stress. It's a blip in the radar. The biggest fear out there, and this is human nature to do this. We're in a call earlier today, just saying that people buy high, sell low. The complete opposite of how you make money in this world. You buy low, sell high, and when you see something like this, that there becomes a problem in the marketplace, you might see, oh, my God, I've dropped value in this property. Well, you sell cash flowing? Yeah, I'm doing okay. I got to sell it. I'm losing value. Not saying, but there is irrational fear that comes from this humans being involved in the transaction. Well, I got to sell. Oh, you don't need to sell. You weren't planning on selling. Well, I better get out now before your price is going to tank. And that happens. That happened the last couple of years. You saw a lot more properties come in the marketplace. People were trying to sell some stupid prices too. At prices you're like, that doesn't make sense, but they're trying to still ride the highs from the higher prices we had and get out unscathed and no problems and walk away with the equity. In hindsight, if they didn't plan on this, if they had no future plans 3 years ago to sell that asset at that point, now it's not in their long-term strategy, should have held on to the asset. Just hold it, ride the wave. It's called an investment. Ride the waves up and down. Not everything goes up. Everything that goes up must come down. Remember that.
And we've seen plenty of investors that have a nice little portfolio that they've built up because they started buying around 2008 and they started finding those properties that were worth keeping or that were other people were just getting rid of. And I know a couple from Yakima that's how they bought their whole portfolio. And that's how he made a good chunk of his money was just buying stuff cheap and holding and selling at the right time.
That's really how a lot of very profitable, very successful businesses started in downturns because they see opportunities out there that there are niches they can fit into that fits well out there that's a very makes them very successful and they grow in there. People double and if you're buying properties in real estate in those times, you're getting them at prices. You're the person when everybody else is selling, you're buying. That's how people make money is when everybody else is selling, you get in. And as I mentioned on our marketing call earlier, that everybody else wants to get out. Let's double. I think this is a good time to help clients out because I think when everybody else is getting out, that's when people jump in. It's the best time to jump in. When everybody's getting out, you start to go, why are you getting out? Why are you getting out now? Like, I'm getting in now. And when everybody's getting in, that's when you go, I'm getting out because you have too many people that get in and they bought properties over the last year or two. And now they're freaking out because it's not worth what it was when they paid for it. But that's okay. That's okay, guys. That's just ride it out.
You weren't
Surf over that
planning on
wave.
selling it now anyway. You were planning on holding it
But
long just because it's
but
dropping
look at
short
that.
term.
Yeah. But look at that. Going back to the maturity thing, let's talk through how that looks out from a refinancing perspective.
Yeah. What are some of the actual numbers on that? I've pulled up some, but you're a math whiz in that brain of yours, Matt.
So, a lot of it goes back how long you've held the. So there's multiple factors in here. So when you got the loan, what was your amortization schedule? What was your interest rate, right? Have you made any additional payments towards the loan? Have you been putting back reserves? Who knows if you need that or not now? It's a good time to think about it. But you take that reserves and you cash you have on hand and a typical normal amortization schedule. So you have a $5 million loan at 3.5% interest, right? So you're $14,000, $15,000 payment, right? In between there. And that same loan today is going to jump up. That math is correct. It's going to jump up to $35,000. You got to think if you have that same loan, let's say you did an interest only product too, that's even puts you in a bigger pickle, right? You didn't pay any principal down in the last 5 years. And now you're sitting here going, I need to refinance this thing at principal and interest payments at double the rates. That can definitely, you're squeezed. So if in this delta here, if we have almost a $20,000 a month delta on payment, how does that, how much more money did you need to make on that property?
A lot more.
Yeah. But significantly amount of more money on that same property. And is that viable? Were you able to raise rents to accommodate that? What were you able to do over that time? That is something that people don't think about. Like, what are you talking about? Like, no, have you played this out? So in our underwriting, one thing that Jay always does when he underwrites a loan for us, he has a sensitivity page in there. What happens in 5 years on a rate reset? Where would rates have to be? What's the max? I should say, not where rates are. What's the max interest rate that you could absorb on a repricing and re-amortizing the loan because you're refinancing it to be able to be at a debt service coverage requirement of 1.2, 1.25, whatever it may be, the standard of that loan type, asset type. So he takes that into consideration and go, oh, well, rates not to go there. I'm okay. I don't see the road ending like that. Or, ooh, that's a little tighter than I thought because, we had to we're taking some assumptions and growth and things like that, but at least helps people understand what situation they would be in 5 years down the road.
What can people do to not be making mistakes right now? I mean, other than the obvious of just sitting on their hands and hoping that it all gets better.
Well, one thing is making sure the biggest thing is don't pay too much money for a property in today's market. Don't be bailing out those sellers that might be in a pickle at prices that are not sustainable for you into the future. It's probably number one. Number two is be proactive on managing your property, manage your expenses, manage your rents. The other coin that I forgot to mention earlier is there's some people that had the expenses creep up, but they've had tenants, long-term tenants in these buildings, either in their multifamily or even in like industrial space, commercial space, retail space, whatever, that rents have not moved up. For one, in the multifamilies, they just said, "Oh, my tenants are great paying. They continue the same rents for the last. They've been paying the same rents for the last 10 years." And you're like, "Well, I ain't gonna do any good when property taxes have gone up. You've had insurance go up, and now all of a sudden your loan's going to go up. How can you afford that new debt?" So if you're not proactively managing your properties, the one that's out of their control is if you had a long-term lease in place and rents only went up, you didn't have a high increase in there. You only had a 2% in there. Did it actually keep up with where it needed to be in market today? Were you actually where you need to be? Are you still below market because you just didn't have a good enough rent escalator built into your leases?
Well, and it goes just as a broad tip. We see far too often with people that have a decent number of properties where they don't have good profit and losses that they're having available for loans. Now, yes, it's good for us to have those in loans, but what me and Matt are talking about right now is having these so that you can be making adjustments and staying on top of your properties throughout the year, not just at tax time, not just at when you're filing for your next loan. You should be having a discussion once a month with your property manager of like, what's the state of my property at? How's things going? Have costs started to rise? Is there tenants that maybe we should start go for it? It's like you got to have those pieces of information. You're running a business. You may think of it as just like it's real estate investing, but you have to be able to make financial decisions based on what your numbers are showing, and you can't just look at it once a year. That's not going to work.
Some of them don't even really look at it. They just hand the information to their CPA and they file taxes. So they don't even know what they're making, what they're not making on their properties. And so the lack of management or just that's not even full-time management, just oversight. Sometimes one thing I also see quite a bit missed from clients is I ask for their P&L, like a T12 or a P&L on their property and they give it to me from their property manager. They're missing usually two big expenses on there because a property manager is they're typically not paying their insurance and they're typically not paying their property taxes. So if they're not paying every expense, that P&L you got is not fully reflective of the profitability of that property. And once you add that back in, you're like, oh, that's all you're making? Are we sure? Yeah, yeah, we got everything caught for this time. And when you explain that back to them, it's like you're in the headlights. They're like, what? I'm like, yeah, yeah. Kind of important expenses, especially since, some that's pretty significant portion your of your expense categories, insurance and taxes on properties, especially when at that point all you have is repairs, property management fees, and where the tenants are paying everything else, utilities and paying everything else on that facility, and you're just paying for those few other outliers. Yeah, those things are kind of expensive. So understanding your portfolio on a regular basis and doing a review of your portfolio can help, and manage that portfolio can help prevent this, not just the one that's coming up, but this will come and go. We'll see another wave because if everybody's repricing now or refinancing now, what's going to happen in another 5 to 10 years if they refinance? We're going to have another refinance tidal wave coming through.
And that's kind of the
But the
cycle
only
we.
benefit is that big cycle will not be the same because people will be more active because we're at a higher rate environment, hopefully, than what we will be in the future. So they might be more proactive and refinance. And rates drop 1.5 points and go, okay, for a couple of years I can ride this. Now rates got down to this point. It makes sense to refinance and reposition my debts. And that's what a lot of people were doing back when rates got down to the threes. But there was also a lot of buying and selling and a lot of that transactional stuff happening at the same time
And a
because of the
lot of
COVID
leveraging
era.
up because there was a lot of people that were just refinancing to max the amount of cash out that they could get so that they could go buy, so they could go do other things with it, but putting the max amount of debt that you can against a property because of the lowest rates that we had ever seen. So, um,
Max leverage makes sense in some
oh,
situations.
I'm not shooting on
If
leverage.
nah, it's how you manage it and understand that it is a tool, and it's a tool, which it also means it can be a weapon against you or for you. And how do you manage that, and how do you manage what that is leveraged against?
If you keep good on all your financials and you can stay up on this, you can start preparing for this type of scenario before it's ever happened. That's the other key there.
Yeah, and if you're there and you have clean and you're managing the property, it is easy and you're still running into the problem, you can at least have a better, fruitful conversation with your lender back or find other solutions out there to get you out of the pickle that you might be in. So if you have been actively managing your property with actively, which includes getting financials on a regular basis, understand that you're under market or just at market rents, wherever you need to be, managing your expenses tightly, and you're still at this problem just because the world's happened, you can at least show that you had the management oversight and the ability. You've done everything within your power. And usually at that point, lenders, being on the lending side that I was before, on the other side of the desk, I was much more appreciative of somebody coming in. Hey, here's what I've done so far. I've done everything in my power to do this. However, this world's coming at me and I can't get away from the world right now. And you're like, okay, so you're an active participant borrower and you're being proactive. I am willing to work with you. And then somebody comes in and goes, yeah, I didn't know this was going
It
to
hit the
happen.
fan and I can't do anything about it.
I wasn't expecting this to happen, guys. I was expecting that, everything would just worked out perfectly like it did when I bought the property or refinanced it 5 years ago. Well, so what did you do in the past 5 years? Nothing. Did you increase rents? No, my tenants were great. Well, you were really good. I'm glad, but you're not a charitable organization, right? You're not a 50c3, right? You're a for-profit investor. Yeah, then why weren't you managing this? So this shows me that you don't care because it's not your money. So that's how lenders view that. It's always that relationship thing. And that's, one thing people always miss. Like, well, it's the bank's money. Well, yeah. Yeah. Do you really want to lose your asset? And if they can't be made whole, guess what? They're going to take more of your assets. If it's a recourse loan, they're going to, they're going to come after more of your assets.
Yeah, I mean that's the biggest risk of all this is if you aren't making the right moves, you aren't able to refinance, you're going to end up potentially being at a place where you might have to hand the keys back, and that's never a fun thing. No one wants to do that, but it's a reality out there, and it's part of why lenders try to encourage you to stay within the debt service ratios that they're wanting. It's why they keep your loan at the certain amount that they're wanting, is they're trying to make it so that even if things go bad in a couple of years, you should be able to refinance it and get another loan for it.
They're your biggest equity investors. Let's just say it was at 20% down. You put 20% in. The bank put 80% in. They had the greatest risk. And I always get frustrated when clients go, banks got to be more generous than this on their rates and stuff. I'm like, they're giving you the majority of the money to do this. Yes, we can all have our opinions that banks make a lot of money, but on the lending side, yes, they got a spread. They're doing their things. They're not looking for you to go. They don't want to take over your assets. They really don't.
And there's some lenders out there that is what they like to do, but that's so far and few between. And majority of the time, they want to see you succeed and have their debt be paid back. I mean,
Unless you're dealing with Guido or, somebody else, Uncle Vinny or something like that, you're probably okay on them wanting to take back your asset. But if you manage the asset well and things like that, you're not going to be in that situation. And so the lessons we can always learn in these times like this is, what can we have done better? What can I do into the future? How do I continue to manage it? Is there anything I'm missing? Am I doing the best of my ability today, or is there things I could continue to improve on? And it's a continual learning experience. This is not just in lending, this is life. Is whenever things are tough or we have this tidal wave coming at us, how do you manage that situation? What can you take and learn from that situation? And I think that's where the biggest thing comes out of this is an opportunity. Those people who see this as an opportunity and not scary, they go, "Oh, this is awesome. I'm looking forward to this." Either I'm going to improve a lot this property, because they have been so great at managing it. Now, I'm in a great position to acquire some other properties that maybe aren't in a great position. Now I learned a lot, and next time when I'm continuing to manage more properties, I can make more income.
it's a journey. I mean, it's not all about I mean, property managers like, oh, this next property is the one I really need. But really, even once you have it, you still gotta manage it. You still gotta grow it, and you should hopefully be leaving the property in a better condition than when you first bought it. And it's all part of the improving. It's how do you choose to just go on the journey, or do you just resist the journey?
Correct.
So, who do you think is getting hit hard the most with this, or getting hit the hardest?
And the hardest, I'm going to say, just lazy owners.
Yeah,
You want to know the
and that's
truth?
kind of what I was hinting at above. Is
I'm
when
gonna
we
I'm gonna say the lazy owners, the ones who have not been proactively managing their portfolios or their properties, are the ones who are gonna be hit the hardest. The ones that put it on cruise control and said this will take care of itself, it'll all work out in the end. And then realization hits them, and they didn't realize they had maturity coming up. They forgot about it, or forgot about the reprice. And then the bank calls and they go, "What in the world's going on?" The ones is I was considered just lazy.
because those are the ones that most likely missed out on expenses that rose. They missed out on potentially raising rents as they should have. So now their property might still be cash flowing pretty much the same place it was when they bought it, and that was good at the time, but now with current rates, you missed out on a couple years of rent going up and some management of expenses to try to manage those overall expenses and keep those down.
And this just goes back to the overall, if you're into the real estate market and you're especially if you're going to be using leverage, you need to be treating this like anything else, is proactively managing it. Most people, if you have a financial advisor out there for your stock portfolio, or even if you just throw into a mutual fund, guess what? There are managers behind that are actively managing those portfolios. So one way or the other, if you're invested into the stock market, unless you bought the few stocks yourself and only bought those stocks and just let it sit there and ride, typically you're going to be diversified more than you know, and they're going to be actively managed more than you know. And why not treat that just like your real estate?
So, what are the some takeaways? How do we make people feel warm and fuzzy after this, Matt?
Yeah, warm and fuzzy is if you guys are not the lazy owners and you guys are the ones that have been proactively completing everything, you're probably in a good position today. You're in a good position from a couple aspects. You can sell the asset because prices are still somewhat elevated to where I honestly think they should and could be. So I think you have room to grow there. I think you have either sell that property and buy something else that's maybe not been as managed as well. And you could take a hold of that opportunity where if you had the skill set to do it and you're selling to somebody who wants more of a passive set on a cruise control and you set your property up for that, you can hand over the keys to that kingdom at a decent price and get a good return on what you have in equity at that property and turn it over into another property that you can now swing back up and increase some sweat equity in that property and build some more equity back. So there's an opportunity for people that have been playing the game right over the last few years. Other thing is, if you haven't, there's also other strategies. We can look at your overall portfolio. We can look, there's other ways to come about things. And it's just building a strategy. There's still time if you're not against, you don't have a gun against your head. You don't need to make a decision today. Start planning today. Even if it's 12 months down the road, you're like, man, I don't mature until February of 2027. How many months down the road that is? I think it's 10. So if you don't mature for then, plan now. Get your ducks in a row. What can you do if you have not been actively managing, what can you fix between now and then? I know you're only limited to so much in the state of Washington on actively managing for increasing rents to the rent control to a certain limit, but what can you do? What can you position? Do you have other assets to help position yourself? What else do you have in your holistic portfolio of your overall balance sheet as an investor? So this includes your other residence, your primary residence, includes your stock portfolio. What else do you have that could help you get through this refinance that you might have pending down in time?
I just want people to know that if you guys need just someone to bounce ideas off of, we would love to help. And I'm not saying that just because we're trying to get a deal, but honestly, when we went through COVID, we got really involved with helping people with PPP loans purely just because we wanted to see people succeed through a relatively tough time for a lot of small businesses, a lot of investors out there. And this is a different animal and it's a different beast that we're here with, but there's going to be a lot of people that if they planned aren't going to be in a problem. But if they don't and they wait too long, they think, oh, I can start working on my one that matures in February and October. That's too late to start working on it. Like in the normal commercial loan climb, especially with December and holidays at the end of the year, nothing moves quick. And you could be in January and not have a loan ready to go. And you have to close in the next 30 days. And then you're going to have to look at bridge options and other options like that. So take the time and reach out to someone like us if it's not us and get some second eyes on your situation.
Yeah, we're here to give you advice back. That's why it's advice from the deal run, right? We're here to advise. We try to specialize. I don't just say we try. We do specialize in advising our clients and helping them and helping people that are potential clients. And it's the advice that we give up front is where we provide our value, guys. Is we want to see you succeed in your investment sector into this realm of investments, which is real estate or businesses, help you succeed so you can continue on and build that legacy for yourself on the financial spectrum.
Well, if this was useful, subscribe, give us a like and follow, DM us as Matt always jokes, and we'll see you
Oh,
guys next
yeah.
week.
Give us a DM, guys. All right. See you guys next week.